All right, so we proceed with our discussions on the basic accounting equation. In this particular session, we're going to focus on the cash receipts transactions. Now, your cash receipts transactions are very important for the business because the business needs cash. All right, so it needs cash to pay the employees, to pay for all the other expenses. All right, and also to buy more goods for sale. So if there's no cash in the business, then that's very difficult for the business. And also, for our part as accounting students, this is a very important because it's going to affect a lot of transactions. Cash receipts are very important, but they're also very easy because what we know is that in our double entry transactions, in our double entry principle, right, for recording transactions, with cash receipts transactions, we know that we're always going to debit bank. So that makes our job very easy because we receive the cash, we're gonna debit the bank account, all right? So that means that the first leg of the double entry transaction is always to debit bank. Then we have to think in terms of which account to credit, but we already know the account to debit is the bank account. Right? Then we can analyze the transaction to determine the source of the cash. Then the source of the cash is going to be credited. So if the cash is coming from the owner, then we're going to credit capital because it's a capital contribution. If the cash is coming from our sales, we made sales, then we're going to credit the sales account. All right, but we already know that the first leg of the double entry is going to be a debit to the bank account. Then we have to analyze the transaction to determine the credit, right? So let's just have a quick look at these very easy and very interesting transactions. So we have, in this case, so South Trading is in the business of making furniture. Why should we know the business that an entity does? So that we can distinguish between whether the transaction affects inventory or other accounts. But because this entity is in the business of making furniture, then they sold that furniture to a customer. So this furniture that was sold is inventory. Right. And it's for 15,000 Rand cash. So what we know is that because this amount was received, we're going to debit bank. So that's the first leg of the transaction. In a cash transaction, a cash received transaction, we're always going to debit bank all the time. Then the source of that cash is going to be credited. In this case, it's sales, right? And it's very easy now because in cash transactions, our assets are always going to increase by the bank amount, right? But because sales is equity, all right, and sales falls under income, so income is increased by 15,000. And here we don't owe anybody anything, right? So I think that is relatively straightforward. Then we have another question. So this is dealing with medical supplies. That is a wholesale. Then they sell, then we have a customer, right? The customer paid off an amount outstanding on its account, and the customer paid 23,000. Right. So we go to the books of Mountain Dew. Like I said, remember these are summarized transactions. The proper transactions in your assessments will tell you from which side you are recording. All right. So we are going to record this because this is a cash receipt transaction that we're dealing with, and Mountain Dew received that, right? Not so. Right, so we always know that we're going to debit bank. There's no question. But now we need to analyze the transaction to see from where is the cash coming from. So the cash is coming from a customer. So this customer originally, if you look at this, he paid off the amount outstanding on its account. So this is a credit customer. This is not a cash customer, because a cash customer comes today, pays cash and goes away. But a credit customer, somebody who buys on account, we first of all have to record that as trade receivables. So this money is now coming from our trade receivables control. All right. Or our customers that owe us are called trade receivable control. So the money is coming from customers who owed us because they bought on credit. But we also have to record this customer's name because we need to know how much he now owes. So we have to record this 23,000 in his account. All right. So this individual account is going to be reduced by 23,000, and the total of what all the debtors owe us is going to be reduced also by 23,000. So that's going to be very easy. There's no effect on equity because this transaction does not affect drawings, income, capital, or expenditure. So you might think that this is income, that we received 23,000, but the income is recorded when we actually do the sale. So the original transaction, when we do the sale, we're going to say trade receivables control and also the name of the customer, 23,000. Then we record the sales then. So on the original transaction of the sale, there was income that was affected, right? So equity was affected on that earlier. But now this is the second leg of the transaction where the customer is coming to pay. So it's all now about receiving the money. So we can say, okay, we have received the money. You no longer owe us. All right, so that's how now it's about the bank and trade receivables control. So the bank is going to increase by 23,000 and the trade receivables control will decrease by minus 23,000. So if you want to balance that, 0 is equal to 0 minus 0, right? Just to check your accuracy. So if you look at this transaction, you have to be very careful because when we receive, in this particular case, this was the original transaction. It was for cash, right? And when we made the sales. But now this other transaction, the first transaction was already recorded. Now we are only interested in the customer paying what they owed us, right? Then there is another transaction. So we're still dealing with Monde and Jew. So in this case, they received cash in amount of 90,000. So they borrowed, right, from the bank. So all what we know is that we're going to debit the bank because we received the money. But now, where did we receive this money from? From a loan. And we have to know which individual it was, right? Because we need to know how much we owe ABC. All right. So this is a liability. This is an asset. So assets have increased by 90,000. We have more money in the bank, but of course, this comes from a short-term loan. So a short-term loan is going to be a current liability. And our liabilities are going to increase by 90,000. So like I said to you, transactions that involve cash received are very simple. So in this case, we received, so I structured the question in a way that we're looking at various sources of income. It could be dividends received, it could be interest income, it could be commission income, whatever. So we just received 7,500 income. But we know we're going to debit bank, right? So we're not going to worry about that. Then the source, it could be dividend income or dividends received, interest income or interest received. commission income or commission received, whatever the name is. All right. This is an income, so we have 7,500. You know, this is an asset, this is income, and income falls under equity. So equity is going to be affected because we look at DICE, right? And we have this income having been affected. So our income has increased by 7,500. That also means that our equity has increased by 7,500. And our assets, all right, have also increased. So our assets are always going to increase in the cash in the case of cash received. But of course, in this case, we don't have any liabilities, right? So I'm sure you can see this is very, very simple. So you need to know what's actually going on, who is involved, and how do we represent the transaction. And so what happened is that Mountain Dew, the company we're talking about, withdrew cash from the ATM so that they can replenish the petty cash reserves. So they withdrew 5,000. Now in this case, they withdrew from the ATM. All right, maybe they send a messenger. The messenger withdraws the money with an ATM, within the card. Now they want to use that money as cash. So it's just money they have, which has moved from being in the account to being cash on hand. So the bank account is money in the bank account. So it is reduced by 5,000. But we now have petty cash, which we received, and it's a debit of 5,000. Now petty cash and the bank are both assets. So this is not going to affect equity. This is not going to affect liabilities, but it's going to affect assets. So petty cash has increased by 5,000. Then the bank account has decreased by 5,000. So the net effect is going to be equal to 0, 0, 0. The net effect on equity, 0. Net effect on assets, 0. Liabilities, 0. All right. So I think that's very easy and enjoyable. Now we come again to this guy, but in this case, they negotiated a loan with V Bank to purchase a piece of land worth 1.5 million. So what happened in this case? V Bank paid the amount directly to the seller of the land. So in other words, Mountain Dew did not receive that cash. Right. I included this transaction because it happens a lot where you enter into a loan arrangement with the financial institution. Then the financial institution doesn't pay into your account. They're going to pay the motor vehicle dealer directly. And then the motor vehicle dealer releases the motor vehicle to you. So you have the motor vehicle and you owe the bank, but you don't owe the motor vehicle dealer because the bank paid directly to the dealer. So yes, now we have more land. It's not going to be bank. So I did put this in here because most students find it confusing. They would put bank here. But we only put bank if we did receive the payment into our bank account. And then after that, we are the ones we have to pay the seller of the land. All right, we have to do the transfer. But in this case, that's not what happened, right? So basically what happened here is the V Bank paid directly to the provider of the land, the seller of the land. So we got the land, it's an asset, it's 1.5, but we also got a loan. We never got cash, right? So it's a mortgage, and because it's a mortgage, we also need to know who provided that so that on the account of V Bank, we can update this 1.5. And of course, this is going to be very easy. There is no equity because there's no DICE involved. Then we have assets. Land, of course, non-current assets, if you want, has increased by this amount. But of course, our mortgage has also increased by this amount. So if you want, you can do a quick check to see if your basic accounting equation is going to balance. Then we come to the last question. So the last question is a bit interesting, but it's not complicated. Remember, eventually we will come to transactions where we will include VAT, and that's going to be a lot more interesting. But for now, there is no VAT being involved, so we can be happy. So what happened in this particular case then? All right, so during August 2023, a customer called Monza Limited, right, paid 7,300 in full settlement of its account of 7550. So this customer had bought on credit before, so they were settling their account. So maybe the total amount that they owed us is 7550, right? But they only paid 7,300, and that is in full settlement, to say we agreed to that. All right, to say, okay, you can pay 7,300. So what it means is that we gave them a discount. We granted them a discount of the difference between what they owed and what we allowed them to pay. So the difference between that two, we gave them. It's a customer who's paying us, and we say, okay, you're paying us on time, right? We're gonna give you a settlement discount. So we granted it to them. So in our bank account, we actually received 7,300. This is the actual amount of money that hit our bank account. Then we're releasing this guy from what he owes as 7,550. We also have to put in his name here as Monza, because we need to record that in his account. Then we need to remember that settlement discount granted is the difference between those two. All right, it's 250. So what is settlement discount granted? It's a loss of income. Remember, we charged this guy 7,550, but we have since reduced the price to say, okay, because you're paying us on time, just pay a little. So it's a loss of income. This settlement discount granted to a customer, it's a loss of income. So it's going to affect equity negatively because we have lost income. All right. So you can think of it as an expense, or it has an expense effect on equity. Right. So when it comes to equity, we know that we have reduced the income we were supposed to get by minus 250 as a result of the settlement discount granted. So I repeat that the settlement discount granted is the difference between what we allowed a customer to pay in full settlement. So the difference between that amount and the full amount that was owed is going to be settlement discount granted. And there's also what we refer to as settlement discount received. When we say received, it's received by us. When we say granted, it's granted by us. So the other person received, we have this settlement discount granted by us and received by the other person. Correct. But for us, it's called settlement discount granted because we're looking at ourselves and say, we granted that. So when we look at settlement discount received, we're looking at that which is received by us. So you need to be careful there because they can be slightly confusing. Okay. And so settlement discount received is when we pay cash in time and the supplier we are paying says, okay, you can pay less because you're paying in time. Then the difference is settlement discount received by us. It's a benefit. Right? But when we are the ones who actually grant it, it's an expense. And then our assets is going to be an increase of 7,300, right? Right, this is our customer, so I did make a mistake there. It's not trade payables control here. It's actually trade receivables, so it's my typing error. I also put it on the wrong place. So we have trade receivables control here. If you can just, then it increased by 7, it decreased by 7550, which is the total amount that we were owed, and we've cleared it off. So our trade receivables, what our customers owe us, has been reduced by this full amount. Right. So if you want to do a check there, we have 250 is equal to, this one is also minus 250 plus 0. All right. So that's a transaction with settlement discount granted. And I want you to be able to understand this, because soon we're going to be doing transactions with VAT, and VAT will be included in a lot of these adjustments. So you need to, first of all, understand the basic raw transaction. All right, and then we can add extras, and then it shouldn't be too difficult. All right, so that was it for cash received.